About 900 years ago, what was then the Republic of Venice in North Italy rolled out enforced government loans called prestiti in order to fund wars and increase defence spending. Wealthy members of the public were required to lend their money to the government with no promise of when they'd get that money back. Instead, they were given a flat interest rate and the ability to sell those loans on the open market. That was the first recorded example of what we now know as bonds, or in this case, government bonds. And I think it's fair to say that they've come a long way since then. But what exactly does a bond look like today? How do you invest in bonds, and why might you choose a bond over buying shares, commodities, other assets, or just leaving your money stored in cash? In this video, we'll cover all of that and more. We really want this to be the #1 resource you need to get started with bonds. So, by the time you're finished watching, you'll know whether bonds are something that you'd like to consider, whether they're the right fit for your approach to investing, how to actually go away and buy them, and a whole load more. You can use the timestamps to skip to different sections if you're already familiar with certain parts of bonds, and please remember that nothing we say in this video is financial advice, all investments have risk, and past performance is not a reliable indicator of future results. We'll start with the basics. What is a bond? Simply put, a bond is a loan. Government bonds and corporate bonds are the two major types of bond, and when you buy a bond, you're lending money while the other party promises to pay you regular interest, with a set date in the future where they will pay you back the full amount that you put in. This is known as the maturity date. Some bonds will mature in just a few days or a month, some will have a maturity date of 1 or 2 years, whereas others could last a lot longer, and it will always state this maturity period before you buy them. However, you don't have to hold a bond until it matures. You can sell it on the bond market before that date if you want to, which is why bond prices can go up or down depending on things like demand and interest rates, which we'll cover in a second. You can either buy individual bonds, meaning you lend money to one party with a specific maturity date, or you can invest into funds that hold multiple bonds at once. Bond funds will consist of lots of different bonds. The fund will pay you an income, likely on a monthly or quarterly basis if it's a distributing fund, or the income will automatically be reinvested if it's an accumulation fund. Typically, there's no set maturity date when investing into bond funds because each bond inside the fund will have its own maturity date, but the fund will continue buying new bonds with its funds. There are some bond funds that do set a target maturity date, but I'll talk more about them later. For now, we'll focus on individual bonds. The original price of a bond is called its face value, and this is typically a rounded number like £100, £1,000 or £5,000, with the most common face value being £100. Bonds are bought and sold daily on the market, meaning that the price of them will fluctuate. If a bond's original price was £100 and it's trading at £100, that means it's at par. Then if it's trading for less, say £95, it's called a discount. Not a birdie, unfortunately. And if it's at a higher price, that's known as a premium. These prices move inversely to interest rates, so if the government hikes interest rates, the price of existing bonds will fall, especially older bonds offering lower interest. Then if interest rates go down, existing bond prices that haven't matured are likely to rise, with older bonds being more affected as they now offer a more appealing return. Now, I know this might start to sound confusing at this point, but don't worry, it'll make a lot more sense once we've covered everything. And if you're unsure about anything we've covered so far, I recommend either sticking with it or rewatching any sections that you need. So, the interest that you receive from a bond is called the coupon. Sadly, not one that you can exchange for a shaken martini. The coupon is listed as a percentage value, so if a £100 bond has a 5% coupon, you would receive £5 per year in interest. Interesting fact, the reason it's called a coupon is because when you used to buy a physical bond, you'd actually get a coupon that you could tear off and take to the bank.
Excuse me. Thank you.
The yield of a bond tells you the actual interest that you're receiving, which is not always in line with the coupon. If a bond has a 5% coupon and trades at £100, the yield would be the same at 5%. But if the same bond is priced at £90 and the coupon is still 5% of the par value of 100, you'd actually be getting a 5.56% yield. So the yield goes up when the trading price goes down and vice versa. This line graph explains it pretty well. Even though bonds are considered a much safer alternative to shares and commodities, they're far less volatile and significantly less likely to crash in price, they still carry what's called credit risk, often referred to as default risk, and this is the chance that the issuer won't pay you your full amount of money back. Government bonds, known as gilts in the UK or treasuries in the US, are far less likely to default than corporate bonds. As bad as everyone might think it is, in modern times at least, the UK itself has never failed to meet its debt obligations. Whereas if you were to loan a business some money via a corporate bond, there's a higher chance that it all goes down the drain. There are credit rating agencies in place that will rate the risk of each bond, and this ranges from AAA all the way down to D for default. If a bond is rated AAA by an agency, it means it's a lot safer than one that is rated BB, for example. And yeah, they use multiple letters for some reason, so I've put all the ratings on screen now for you to see. A BB rating would imply that this bond is more of a gamble, but you might also get a higher coupon for your troubles. Simply put, more risk, more potential reward. But also more risk. You can buy bonds in between interest payments as well, but you will pay a little bit extra for it because of the interest that's already built up. This is called the dirty price. Let me explain. Here's a bond. It trades at £100 and pays £5 in interest over the course of a year, with two payments of £2.50, one on the 30th of June and another on the 31st of December. If you were to buy that bond off of someone in, say, September, the bond will already have accrued some interest since the last payment, even though that interest hasn't been paid yet. So when you buy the bond, you're not only paying the clean price of £100, which is the market price, but also a bit extra for that accrued but unpaid interest, meaning you might pay around £101.25 in total. This total, so the clean price plus the accrued interest, is called the dirty price. But don't worry, you'll still get the full £2.50 interest payment on December 31st, so that extra £1.25 you paid just compensates the previous holder for the interest they'd earned before selling the bond. So why do some people like bonds? Well, not everyone likes the unpredictability of the stock market. They'd prefer their money to be somewhere secure, generating a steady return. Lots of people already do this via their cash savings accounts in the UK, and the UK really does love a cash savings account, even though they've performed absolutely terribly over long periods of time. Maybe bond purchasers want to live off the interest, or they're closing in on retirement so don't want to face the possibility of a stock market crash just before they start taking from their pension. They could also just want a place to hold their cash, with the promise of getting it back in full plus interest at the maturity date. The interest rates on offer tend to be higher than savings accounts because you're the one taking on the risk. You also don't suffer from the same volatility in price as you would with shares or commodities, and especially things like cryptocurrency. While some share prices can experience swings of 10% in a week, a high quality bond wouldn't change nearly as much. The biggest bond market crash in modern financial history is widely considered to be the bond market rout of 2022 to 2023, where the global bond markets dropped around 20%, the worst year in recorded bond market history. And just to emphasise, that was 20% in a year, not a day. The biggest stock market crash was around 55% globally during the 2008 financial crisis, or between 80 to 90% if we go all the way back to the Great Depression in the late 1920s, early 30s. Then there's the diversification benefits. People like having a well-diversified portfolio that consists of shares, bonds, commodities, properties, and all sorts of other stuff, so that they have a hedge if one of their investments should tank in value. Bond and stock market performance are somewhat negatively correlated, meaning when one does well, the other usually performs poorly. However, during more extreme market conditions, this isn't always the case, but nonetheless, it makes them fairly reliable hedges against each other. But it's not all sunshine and rainbows. There are a few scenarios where bonds could go wrong, and one of them we've already mentioned: the risk of the issuer going bust and you not getting your money back in full. And seeing as bonds are an investment, you will not be protected by things like the Financial Services Compensation Scheme. You could also buy a bond with, say, a 2% coupon, only to see newer bonds pop up offering a 4% coupon a month later due to interest rate fluctuation. And that can be frustrating. If you're planning to hold the bond to maturity, you'll still get the full amount back, as long as it doesn't default, of course. But a major concern is inflation risk. Bonds don't typically pay high interest rates, at least the ones that are considered safer anyway. So if you're getting a 3% coupon, then inflation hits 4%, you'll still be getting your money back plus interest in nominal terms, but the spending power of that money will be worth less in real terms. What you used to be able to buy with that money is now worth more than the amount you've received back in return. On top of everything we've just discussed, bonds aren't always the easiest things to sell either. Government bonds tend to have a large amount of available buyers, but if you're dealing with a smaller business, it could be harder to move it on. And that could result in you selling at a lower price and either missing out on returns or even losing money. Now, when you're generating returns, something you always have to consider is tax. When buying bonds here in the UK, you can hold them inside of a stocks and shares ISA, meaning you can avoid most taxes completely, and you won't need to report anything to HMRC. And if you hold bonds inside of a SIP, you also won't need to pay additional taxes while you hold them. Although do bear in mind that if you're buying foreign bonds, you could run into things like foreign withholding tax, which you'd still need to pay even inside of an ISA. But outside of tax efficient accounts, bond interest is treated like savings income. So basic rate taxpayers get a £1,000 savings allowance, higher rate get £500, and additional rate get a big fat 0. If you go over this allowance, then the income is taxed at your rate, so 20%, 40% or 45% respectively. UK government gilts are exempt from capital gains, and so are a lot of corporate bonds as well, but not all of them, so be sure to do your research as always before you invest. If you're watching this outside of the UK, then you will have to look up how different types of bonds are taxed where you live. So we've mentioned both government and corporate bonds so far, but these aren't the only types that you can invest into, and there are actually lots of different kinds to know about.
The name's Bond.
UK Treasury 0.25% the 31st of July 2031.
Bond.
UK government bonds, or gilts, are a loan to the UK government. They pay you interest and will be paid back in full at the set maturity date. They're considered pretty safe, although all investments do have risk, and they're mainly for those that want a low risk place to store their cash while gaining a little bit of interest on it. Corporate bonds are loans to companies, usually large public ones, but sometimes private firms too, and they can come from any market sector, big or small. You're essentially lending the company money, and in return they'll usually offer higher interest than something like a gilt, mainly because there's a greater risk that the company could default on its debt obligations. With that said, the bigger the company, the less likely your corporate bond is to default, but equally, the less interest you'll probably receive. If you decided to loan your money to a new startup selling kazoos to anteaters, you might be promised an 11% coupon, but you'd be lucky to ever see your initial investment again, even if it would be one of the best choices of instrument for an anteater to play. These smaller, riskier corporate bonds actually have their own category called high yield bonds, or as others like to call them, junk bonds. With high yield or potentially junk bonds, you might see a glamorous looking coupon slapped onto it, but the chance of your money seeing the light at the end of the maturity tunnel is a lot lower. Hence why people like to completely disregard them unless they're an optimistic adrenaline junkie seeking a high risk, high reward investment. Although this might stretch into speculation or gambling. Index-linked gilts are another kind of UK government bond that move their payouts in line with inflation. These tend to have long maturities and fairly volatile prices due to inflation expectations, but can be an option for those worried that inflation will slowly eat into their savings. You then have foreign bonds, which are simply bonds issued outside of the UK, or maybe they're not foreign if they're issued from wherever you live, but you get my point. There are things like US treasuries, German Bunds, Boobles and Baubles. I appreciate that really sounds like I'm making those up, but I promise you I'm not. And there are bonds that are available from all leading nations and emerging markets. Foreign bonds can come with extra baggage in the form of currency swings and additional taxes, so make sure to do your research before you invest, as always. There are also municipal bonds, but these are pretty rare, and these are usually issued by local councils to fund things like green projects, making them pretty niche and hard to trade. So now you know all of the basics about bonds, how do you actually buy one? We'll start with individual bonds, as these aren't available through every broker, whereas bond funds are more commonly available on platforms via both ETFs and OEICs, so be sure to check if your platform offers them before you go searching. I'm going to show you how to buy them using Hargreaves Lansdown, but this is not a recommendation, I just needed a platform that actually offered individual bonds and went with HL. Sign up and open either a stocks and shares ISA, SIP, or general investing account, and then click Deal Now, and you'll have the option to filter the assets by stock type here. If you're only looking to invest into individual bonds, then unselect the rest and either type in the name of the bond that you want to buy, or search a term like bond or gilt to narrow things down and click search. So say you wanted to buy a gilt, type that in and you'll see a list of all the different options pop up below. Each of them will have the basic details in the name, like this one for example is called Treasury 0.25% 31st of July 2031. Meaning you'll be paid an annual interest of 0.25% and the bond will mature on the 31st of July 2031. Now, you might be thinking, why would anyone invest into something with a 0.25% annual interest rate? And that is a great question. First of all, this gilt was issued on the 13th of November 2020, and at that time, the interest rates in the UK were near rock bottom, sitting at just 0.1%. So, while it may seem like 0.25% is ridiculously low now, it wasn't too bad compared to the rates at the time. But that's not the only reason why you might consider an older bond with a low coupon. In reality, the interest rate listed on the bond isn't the same as the return you'll actually earn. I promise this will make more sense in a moment. When you click into a gilt, you'll be able to see a chart of its price. But you might not need to worry if it's going up and down a lot, because if you hold the bond all the way to maturity, you'll get the full face value back anyway. Over here, you'll find the running yield, which gives you a rough idea of how much interest you'll receive each year based on the current market price, rather than its original price. As I mentioned earlier, even if you buy a bond at a discount, the interest that you receive each year stays the same, meaning your effective return is higher than the advertised rate. But the interest that is advertised in the name doesn't change. I'll use the same example as I used before. If a bond is priced at £100 with a 5% coupon, you'll receive £5 in interest every year you hold it. However, if that same bond is discounted to £90, you would still receive £5 a year in interest. This means that you're now receiving 5.56% interest a year, but the bond will still say 5% in the name. So in this example, 5.56% would be the running yield, which you can use to help compare different bonds. However, and this is important to remember, the running yield is a little misleading as it doesn't factor in any gain or loss you'll make when the bond matures. In this example, the bond is discounted at around £20 below the par. So if you held this until maturity, you'd receive all of the interest plus the difference between the purchase price and the £100 repayment value, meaning the real return would be much higher than the running yield suggests. To see that real total return, known as the yield to maturity, you can use an online calculator which takes into account both the interest and any capital gain or loss, giving you a much clearer picture of what you'll earn if you hold the bond to the end. In this example, as you can see, our return is much closer to 4% as opposed to the 0.307% running yield that is displayed. So once you've figured all of that out and you're happy enough to place an order, click the deal button here and you'll be taken to the dealing page. If the markets are open, you'll be able to execute the order instantly. But if they're not, you can place what's called a fill or kill order, which will allow you to set the maximum price you'd be willing to pay, so if it's over that when the market's open, the order just won't go through. Something else to consider here is your platform's specific dealing fee. On Hargreaves Lansdown, you'll pay a fairly hefty £11.95 per deal on bonds, so if you're only buying a small amount, make sure to take this into consideration as it will significantly eat into your returns, or maybe even wipe them out entirely. I'll put a link in the description with some cheaper alternatives than HL that will still allow you to invest into bonds. When it comes to buying corporate bonds, again using HL as the example just because it's so well known, type the name of the company into the key terms bar here and only select bonds and gilts. For this example, I'll look at this National Grid bond, but in no way is it a recommendation of what you should actually invest in. As you can see, this bond is trading at a higher price than the par of 100, so remember that when the bond matures in 2028, you will only get £100 back, not this premium price, and this is reflected in the running yield, which is lower than the 6.5% coupon. Then the modified duration percentage above tells you how much the price of the bond would fall if interest rates rose by 1%. So if they did rise by 1%, the price of this bond would decrease by 2.49%, meaning it would drop from £106.60 to £103.95. This is because the coupon it's offering is now less appealing due to the higher interest rates, which results in the price dropping. Like I mentioned before, whenever interest rates go up, current bond prices go down and vice versa. They move inversely. Buying individual bonds isn't for everyone. They're complicated and sometimes hard to decode, so a lot of people opt to invest into bond funds instead. A bond fund will spread your investment out across a variety of different bonds, then it will pay out periodically via income, and this could be every month, every 6 months, or even once a year depending on what type of bond fund you're investing in. You can either choose to invest into accumulating or distributing bond funds. Distributing funds will pay you income, whereas the accumulation funds will automatically reinvest that income back into the fund. The fund itself won't have a set maturity date because every individual bond inside the fund has its own maturity date. And when one of the bonds matures, the fund will likely just buy another one to keep the fund growing. There are some bond funds though that set a target maturity date, and these aim to only buy bonds that mature before a set date. Then once that date comes, the capital will be returned to the investors and the fund will cease to exist.
No, Mr. Bond, I expect you to die.
If this is the case, then the target maturity date will be clearly specified on the fund page before you invest. The two main types of bond funds are OEICs, or open-ended investment companies, and ETFs, which stands for exchange traded funds. There are other types of bond funds, but for simplicity, we'll focus on the main two in this video. OEICs aren't available on all platforms and are usually only priced once per day, meaning orders will be filled at the next available price. Being open-ended means that the fund can expand or shrink as investors buy in or sell out, giving the manager flexibility to buy new bonds or replace maturing ones as needed. With ETFs, they're traded on the stock market, making them easier and quicker to buy and sell, often resulting in them being cheaper. Each bond fund will usually give you a rough idea of the income you'll receive per year, and this is labelled as the distribution yield. Then the duration stat will tell you how much the fund might drop if interest rates change. So if the duration is 5, the fund may drop by 5% if rates rise by 1%. This is the exact same as the modified duration of an individual bond, but it's the average modified duration of all of the bonds inside the fund. What's confusing is that the average modified duration can be listed as either a percentage or in years like it is here, and this is because it derives from something called the Macaulay duration. But to save time over explaining this, I'll just leave a link in the description if you want to learn more about it. Bond ETFs allow people to invest with a much lower budget, especially on platforms allowing fractional shares. And if you know what type of bonds you'd like to invest into, they can give you exposure to multiple bonds in that category inside one single investment. But much like individual bonds, if interest rates spike or the bonds inside your fund start to drop, your returns could suffer. Either way, bond funds offer a lower risk option for people that don't want to be constantly checking the markets. To explain how to buy bond funds, we'll be using Trading 212. Unlike HL, they don't have any trading commissions, and if you want to open an account with them, you can use our link in the description to sign up, and if you do, you can receive free fractional shares worth up to £100. While they don't offer individual bonds, they offer a large range of bond funds. To find all of the available bond ETFs on Trading 212, click the magnifying glass here and scroll all the way down to the bottom where it says Browse All, and under this you'll see ETFs. Inside the ETF section, click on Fixed Income, and you'll be able to choose what type of bonds you'd like to invest into, including government, corporate, inflation protected, and lots more. To check the exact bonds that a fund holds, click into it and scroll down to Fund Allocation, and then click See All to get the full list. Once you've done your research and you know which fund you want to invest into, you can hit Buy here. Then to place a regular market order, input the value you'd like to buy, and your order will be executed immediately at the current price. If you wanted to set up ongoing or recurring investments into the same fund or funds, that's quite easy to set up, so I'll put a link in the description that walks you through the entire process, and it'll only take you a minute or two. Bonds are usually favoured by people who don't want to deal with the ups and downs of the stock market, and are looking for a more predictable return on the money that they put in. While typically they are considered a safer option to shares, they can also carry their fair share of risk, depending on which bonds you choose to invest into. It's important that you always check the details of the bond so you know who you're lending your money to and what you'll be paid for your generosity. They're nothing fancy, and they certainly won't make you a millionaire overnight, but they can provide a steady return on your parked cash. For those of you looking for something higher risk, I'm off to set up a business selling kazoos for anteaters. Let me know if you'd like to invest. After all, you only live twice.